Let me just welcome our panelists as well. Ritam Desai from Morgan Stanley, Ratnesh Kumar from Standard Chartered India Securities, and we have Vetri Subramaniam from Religare Mutual Fund as well. The topic of today is value investing and markets. That's what we're going to be discussing over the next half an hour or so. As far as markets are concerned, we have that big event, the budget behind us now. What's the current situation?
Well, the current situation is that as an economy, macros are struggling.
True.
Your investment growth is hovering around 0 plus minus 1 or 2%, which basically has happened in all previous periods of economic downturns. So that is the parameter to look at, is that our investment growth is not there in the economy right now. There may be 20 different reasons behind it, but that's the end result of it. And of course, we have a current account deficit, which is also very, very high. So the macros are struggling, and globally, situation is picking up in a gradual kind of a way. Not everywhere. US is looking slightly better. Europe not so much. Japan not so much. So in that kind of a environment that we have, what we need is for ourselves to be a little bit more extra initiatives to revive the economy, and I think that's where last 6 months or so you've seen some pretty significant actions which have raised the hopes that the things which slowed us down so dramatically, global factors, but also quite a bit of domestic factors, if they can be turned around. It is still a long, hard road ahead. It is not going to be a quick return back to high growth, simply because of the factors which need to get us to high growth are going to take time to evolve. So in that situation, I think from the market, the emphasis on quality businesses, quality managements, quality governance, that is going to absolutely remain still the key. So we may have finished 5 years since the financial crisis started, but I think it is absolutely not the time yet to lower the guard and say that we are entering another bull market. We are not. It is going to be a while before we get into another high growth phase, and the focus in this period has to remain high quality stuff.
Vetri, I've read a lot of articles, I've read a lot about your view as far as the economy is concerned. I know for a fact you track that very closely. How comfortable are you as to what's happening in regard to the macros right now? And in that context, what's the view on the markets?
I think Ratnesh has covered some of that, and the funny thing with even the economic environment is you've got some indicators that are telling you you're almost in the deep freeze, right? So you look at automobile sales, and we've seen that horrendous data which tells you that the economy is in deep slumber, and then you look over at the other side and some of the numbers, the inflation numbers, the current account deficit, and some of this other stuff makes it seem like the economy is actually still overheating. So that is a bit of a dichotomy, and on average you seem to be okay, but actually at the two extremes there's a fair degree of pain. And in a sense, the same challenge is also reflected in the markets when you look at valuations, because you've increasingly got a large set of cyclical businesses which are starting to look, I think, pretty cheap. Growth is almost starting to become an optionality in those companies. And at the same time, you have some so-called non-cyclical defensive businesses which are trading at extremely rich valuations and 2 standard deviations away from what their historical averages have been. So it's not a particularly easy environment to sort of deal with. Our sense is that we are still in some kind of a bumpy ride. I don't want to put a name on it as a bull market or a bear market, but we're still in some sort of a bathtub market, and we're just bouncing around more than having any clear sort of traction either for the economy or, for that matter, for the markets.
What is a bathtub market? That's a new one.
New concepts coming up every day in the market. In an interview to our channel itself, you very clearly mentioned that you aren't very comfortable looking at the FI flow. Now that's really been some concern to you, because it seems that we may have been in a situation that seems overbought. What's your strategy now? How are you looking for this year?
So I'm extremely optimistic. I think global liquidity is in great shape for India. If you look at the trailing earnings yield minus the US 10-year bond yield, which is our indicator, it's at over 4%. And when that number has been over 4%, you've never lost money on Indian equities with a 1-year forward view. So global liquidity is in great shape. I think valuations are in comfort zone. I think corporate earnings will surprise on the upside. All the metrics that we track suggest that there's a big improvement coming in earnings over the next 12 months. It's not there in the forecast, it's not there in the expectations. What's not working for the market and what's creating this volatility and uncertainty, I think A is that FIIs have bought too much stock. So, FII flows have been just too strong. So one part of the market is, one section of the market overowns the market, and that, is a potential risk. And the second thing and the most important thing is that I think domestic liquidity is still tight. Short rates need to be a little lower for the market. So my view is that we will get lower short rates because inflation is coming back under control and the government is consolidating the fisc. But till the time that doesn't happen, you won't get an outright bull market. You'll get a market that keeps climbing a wall of worry because there is a lot of worry out there, and that's a good situation to be in as far as equities is concerned. So I'm actually quite optimistic. I think cyclical businesses will do very well over the next 12 to 24 months. Cyclical stocks will do very well, and the index will go a lot higher.
So apart from the fact that we spoke about value investing, what are some of the critical points that investors need to actually keep an eye out for when we talk about 2013?
Okay, so I think you need to keep an eye on the fiscal deficit and how the government performs on that. So far the news has been good, so that's one thing. The second thing is you need to, if you're tracking an indicator, track M2 growth. It captures everything. It captures the current account deficit, it captures the inflation position, it captures everything. It is essentially a signal to where we are heading in terms of domestic liquidity. So that's a good thing to track. And of course, you want to see how corporate earnings pan out. So I think these will be probably the most important drivers.
And the other talking point in the market has been regarding divestment and what government is planning to do. So Ratish, let me get your view as far as that, because it does have a lot of implication in terms of what kind of impact it can have on the market, going forward for this year itself. How closely are you reading into that entire scheme?
Well, to add to Rhythm's point there, one factor which I would add as something to obviously look out for 2013 is how the situation politically evolves.
True.
Obviously, you have an election in probably 12 months' time or maybe sooner. So who knows? At least I don't. So within that context, I think the government has done a fantastic job in terms of containing the fiscal deficit so far, with some costs of compromised on the capex side. But I think looking forward, whether it's the divestments or OFS, whatever you call it, those are long-term positive things for the market. In the short term, what it has is that it can have an impact on demand supply of liquidity in the market. So clearly, as we all know, and our panelists have mentioned that much of the buying is coming from FIIs, net flows. Domestic flows are negative, and to the extent that there is demand on that flow, it leaves lesser for the secondary market. So long term, it's a good thing. It leads to fiscal correction. There is more float in some of the public sector companies, which is positive. But in the short term, it can put or demands on liquidity coming into the market, and to that extent, keep a lid on the market.
Fair enough. Vetri, how comfortable are you looking at the valuations right now? How do you see it going forward for 2013? Is this somewhat of a comfortable position to actually, for investors to go ahead and deploy some cash currently, or would you still want to wait it out?
No, I think from a valuation standpoint, I think, Rhythm made the point. Actually, if you could look at valuations either giving you a red light or a green light, clearly we're not in red light territory. We're not either blinking clear green, but we're pretty much in that comfort zone close to average valuation. So from that point of view, I don't think valuations are giving you a message in terms of, great fear relative to where the market may be trading at this point of time. So I think really at this point, it's more in terms of just making sure that you are invested in companies where valuations are in that, reasonable zone, and where you can be reasonably sure that that company will be around to benefit from the upturn in the economy whenever it can occur. Whether it's going to happen in 6 months, 12 months, 18 months, 24 months, frankly, I don't think anybody knows. But when it does, you want to be in some of those companies which can benefit from that upturn in business momentum. So that's really the way I approach the issue. And I think as far as valuations are concerned, it's in that comfort zone where you can afford to dip your, feet into the water and fish around for whatever looks good to you.
Rhythm, in 2012, we saw a good gain, 29, almost a 29-30% up move as far as the Nifty was concerned, a good amount of rally. Going forward for 2013, I spoke to you about some of the critical points, but any hurdles that could actually go ahead and spoil the party, which was probably coming to us in this year?
Yeah, I mean, there are lots of hurdles. The market is already jumping over them time to time.
They're trying to, is it?
Yeah, but I think the crucial thing is this, the point on fiscal consolidation, because the policy response in the aftermath of the global financial crisis has caused macro imbalances in India, which Vetri referred to. I think that was a very good point. And the contrasting things that are happening in the country is a function of, or is an outcome of, the policy choices we have made. So it's very crucial that the shift in policy choices that we embarked upon in September last year continues for the next several months. And I think Ratnesh made the point about politics and elections, and that could be an impediment to continuation of that policy. I can definitely see that the market is quite skeptical about it, because the market somehow thinks that at some point in time this year, all this good work will come to a standstill because the focus will move to the elections. And then we will go through a period when the market will struggle for triggers. I think we may not get that outcome, because I think the government has realized that the only way the UPA can come back to power next year is that they get growth back. And they have a very short window left of 12 months. So they have to work very hard to get growth back. So I think that we'll get surprised on the upside on growth. So per se, I don't think that will become an impediment, but that could be one of the factors that could derail the market. So I think that could be the most crucial thing. And the second thing, of course, is the global situation. Morgan Stanley as a firm is a little bit more, I should use the word optimistic about global growth than we were, say, 6 or 8 months ago. But the global situation remains fragile. It is not something that we have fixed. Europe remains in a situation of flux. And it can come back to haunt India, because India has not corrected its macro imbalances. We still run a high current account deficit. So our tolerance to volatility in capital flows is rather low. So that could be the other source of stress for the market. So these are the two things that you want to keep at the back of your mind.
Let me start off with you. Now, value investing as a concept, we've been hearing a lot from some of the most renowned investors, what we've been hearing this term from. The formula basically is buy and hold, and keep holding probably. Explain this principle for us, because that's the most layman language where one can actually put it in. Explain to us.
No, well, that's a very simple way of looking at it. See, I'll go back to basics. Think about a fixed deposit, or think about debt issued by a company. How do you value that? That's a senior claim on the company's balance sheet. The future stream of income is the coupon that you get. You discount the coupon, which is available for, say, the next 10 years at your expected rate of return, and that is the value of the bond. If the bond price is above that number, you will not buy it. If it is below that number, you will buy it. So stocks is the same thing. Stocks are a junior claim and will be valued in the same fashion. The coupon from a stock is the dividends. The time frame, unfortunately, is not defined, so it's almost infinity, and therefore we have the concept of terminal value. You discount the dividends, the expected dividends, by your expected rate of return, and you get a number which is the value of that stock. If the price is above that value, you don't buy it. Now, of course, this is very complicated, because firstly you have to forecast dividends, and the second thing is you have to figure out what return you want to expect, because these are not simplistic things. But in practice, that's how stocks trade. What they trade is basically future dividends. And if you apply that, the discipline, it's a winning game.
Fair enough. Ratnesh, come in on this. You advise a lot of clients, both domestic and internationally. How important is the concept of value investing?
See, value investing is, whatever the investor may call themselves, it's basically at the very core of investing. Now, value investing doesn't necessarily mean that you buy cheap.
True.
Essentially, the way I look at it is that it is about establishing an intrinsic value of a company and buying it at a price which gives you either expected return or a discount to that intrinsic value. So I would not simply categorize value investing, take these 5 parameters. If the stock is cheaper than XYZ, framework that one might have, it is value investing. In fact, I'm reminded of one of the things that Warren Buffett, he had said in books, and he actually acknowledged that he himself fell into that trap a few times and suffered for it, is that his colleague Charlie had told him once, long ago, 50 years ago or 40 years ago, whenever, is that you are always better off buying a wonderful business at a fair price rather than buying a fair business at a wonderful price.
True.
Right? So that essentially is at the core, I think, of value investing, is that you have to buy good quality businesses. That's the first criteria. And establishing a value is as much an art as science. But whatever is the parameter that you're using, essentially, it has to be justified on that basis. But primary criteria is wonderful business at a fair price rather than a fair business at a wonderful price.
Fair enough. Vetri, the other debate that comes in here is when we talk about value investing, the other part to it is, do you buy too much, diversify, or you buy just a couple of companies that you really have conviction on and concentrate on that?
I don't think value investing in that sense has anything to do with, how diversified or how focused your portfolio is. I think that's more to do with your own sort of risk appetite and your ability to track a large number of companies. That's the way I frankly see it, though very often people look at it as being a method of investing in which you invest in a very limited set of companies, but I don't necessarily see it as that. And I'll just add to something which, Ratnesh said in terms of the whole value investing philosophy, which is that at some level I find the whole distinction a bit artificial, right? Because why would you buy anything if it was not value for money, right? And secondly, would you start a business if it didn't have any prospect for growth? You wouldn't. And if you don't, then why would you buy the shares of a company where there was no prospect for growth? And to my mind, the critical difference, therefore, in terms of, what constitutes a value investment is really one in which you are not particularly worried about what price the market may offer you for that asset at a later point in time, because what you get out of that asset is good enough from your point of view in terms of returns. So that, to my mind, is really what constitutes the heart of value investing. You're not focused on what your exit price might be to determine your return.
Yeah, that's an important point, Vetri, that you've actually raised there. Ritam, let me come to you, because as important as the decision to actually go ahead and select a certain company, go ahead and make that decision to actually go and buy a certain counter, it's as important as that to go and exit at the right time. And that's where the difficult part is, because a lot of investors probably lose out at the right time to exit. What determines that? How does one make that right call to probably sell? I mean, I can understand if there is no need, you don't sell, but when the time, how do you determine the time to actually push the button of sell?
I think you have to follow some basic valuation metrics to do that. And I don't think it is a very difficult science if you follow it with discipline. So let me give it in the context of the stock market. If you look at India's valuation history, the market has traded between 10 and 30 times earnings. So if it gets to around 10, 12 times earnings, it's a good signal for you to buy it and back up the truck and load it up. If it gets in excess of 25 times, it's time to sell it. So I think it's not such a difficult process to know that it's time to sell. I tell you, the difficulty doesn't lie in judging whether something is expensive or cheap. The difficulty lies in overcoming the sentiment of that moment, which is when stocks are trading cheap, you are in a very fearful mood. and you cannot overcome the fear to buy those stocks. Likewise, when stocks are trading expensive, you are in a very exuberant mood, and it's very hard to overcome that sentiment and sell the stock. So the challenge for investors is to overcome their mood rather than identify whether it's cheap or expensive. I think most investors realize that. But when the stocks are trading expensive, they usually, it's the best moment for them in terms of earnings, it's the best moment in terms of performance, and usually that's, that becomes a time when you also feel very good about it. And I think the way to judge this is, if you're feeling too good about a business, sell it.
Fair enough, that's a valid point there. When you're feeling too good about a business, sell it is what Rhythm is saying. Ratnesh, this is the same situation you probably come across as well when you talk to your clients. You have the fact that sometimes investors tend to lose the reality. That's what Rhythm is also pointing out. How do you pitch it? How do you deal with it? And what's your advice there?
Well, one of the first box to tick is, have you considered the question that if there is a stock which is cheap, it probably is cheap for a reason. Have you figured that reason? Maybe there is an opportunity, but maybe there is a reason why the stock is cheap. Likewise, just because something becomes expensive, that's not something that I would consider as an automatic trigger to sell it. Like, for example, if you look at some of our multi-baggers in India last 10 years, 15 years, etc. HDFC Bank, HDFC, Infosys, some of the companies which have been growing, they have never been cheap by relative standard, by standards of what other stocks are trading at in the market. So if the business still is growing and you can put a value on that growth, if the management quality is still good, competency is still good, competitive positioning is still good, I think it has made sense to hold on to those stocks rather than saying, okay, I made my 30%, company is still good, but I'm happy with my 30%, I'll go elsewhere.